All right, thank you, Derek, for joining me on the podcast today. He is the founder of Advantage Mortgage, so really excited to get into this conversation, hear a bit about your background and the market, what we're currently dealing with, and then kind of the future predictions. So, yeah, let's go ahead and start with your background in mortgage lending and how you got into the industry, and then how
Oh,
you
geez.
ended up starting Advantage. I know it's yeah, as much detail as you want to get into.
Uh, yeah. Thanks, Connor, for having me. I appreciate it. Wow. So I've been doing mortgages, been in the mortgage business since 1997. So I don't know, almost 30 years. Started out, back then, a lot of the industry was independent broker shops. Probably 40% of the business was done by independent brokerages. And then you obviously had all the big banks, Wells Fargo, B of A. And back then, Washington Mutual was a big one. And back then, it was different. I mean, we did everything by paper back then. So the industry's come a long way. I mean, I remember, we used to have to actually take copies of borrower's documentation and we would stack it in order and we'd then package it in these files and two-hole punch everything, and we had to transbox those files over to the lender that we were doing business with. So things were much slower. Yeah, couldn't imagine. I mean, the transition from now, the speed is so much faster, and everything being done electronically is a lot different. But
Mhm.
the crash of 2007 with all the subprime loans that the companies, the hedge funds that all went under, created a different world for us, and it created an organization called the Consumer Finance Protection Bureau, the CFPB. And back then they were unregulated, they were self-funded, and they were coming in swinging a big bat because, of course, everybody felt like the mortgage industry was the cause of all this, and there was a lot of loans that were done that there was no income documentation on. So anyway, there were everybody was afraid of that. So a lot of these small independent brokers went to go work for bigger mortgage companies because they had compliance departments, and the little guys didn't want the CFPB coming in saying write us a check, and they were doing
Mhm.
that. They were swinging a big bat, and they were finding people millions and millions of dollars for um, not disclosing everything that they did wrong. They would come in and say, "Well, the fine is going to be this if you just agree to everything, or it's going to be this if you want to, disclose everything that." So anyway,
Mhm.
the industry really changed. A lot of these independent brokers went to what we now call the retail channel, where you're funding your own loans. Like you have a credit line, you're funding your own loans, you're underwriting your own loans. And back then, everybody thought that was cool to be called a lender, because you had more control, um, and it was great for a while. Yeah, that leg or division of the mortgage lending industry was great. There was only so many loans we could do back then because all the subprime loans went away. So it was all conventional VA, FHA, USDA. That was pretty much it. I mean, there was not a lot of options, but the most business I ever did was in 2009, 10, 11, because so many people got out of the industry, and I just stuck it out. So yeah, it was a crazy time back then. But now, 15 years later, 20 years later, I started Advantage Mortgage 6 years ago because that retail channel started getting very top heavy, very bloated with regards to overhead, and that just exponentially increased interest rates because that I could offer my customers, because we had to pay for all that overhead and all that, these people that were middle level managers and whatnot. I just saw rates get really, really crazy, and being from the wholesale channel or the independent broker channel, I knew what a wholesale rate sheet looked like. And so I took one of those from a bank that I knew, and I was like comparing it to my rates, and I'm like, there's a whole lot of fluff in here, and it's not benefiting my customers, and it
Mhm.
wasn't benefiting me. It was benefiting the profit of these organizations. So yeah, I just decided I'm done feeding the empire and wanted to do what was best for the consumer, which is being an independent broker where we can access. Right now, I think Advantage Mortgage has over 50 lenders that we have signed up, and we can shop, every single day, whichever lender's offering the most competitive rates. So it's a win, in any economy that allows for competition. It drives, prices down. So it's been working really well for us.
Yeah, absolutely. So Advantage was started 6 years ago, so that's like 2018. What were the initial, starting your own company? What were some of those challenges of starting a company, especially a mortgage company with all of the regulations that you have to deal with? How was starting the company and then going into COVID and working through all that?
Yeah, so starting the company, it's like starting. It sounds crazy, but it really is like starting any other company. Um, Before I got in the mortgage business, you asked about how I got into the business. I got out of the Navy in 1990, and then opened my own auto detail business in 1991. And from 1991 to 1997, I had grown that business to 3 locations and 50 employees, and that really taught me how to operate a business. There's a lot of people out there that are great operators. I mean, I think we can all say that we know a great mechanic that then thinks, I'm going to go make more money and call my own shots, and he goes and starts his own mechanic shop. Well, now he's not just a mechanic. He's got to do all the
Mhm.
finances. He's got to do all the marketing. He's got to do all this stuff. And that typically is where people fumble. And that's what, owning my own detail shop taught me, is how to create systems and how to set things in place where I have a viable business. And so I had all these employees, and I got my first mortgage from a gal up in Battleground, and I was super intrigued by the process, and noticed that it was just her and 2 other people, and seemed like she was doing really well financially. And I said, I think I want to do that. And so I went to her and I asked her if she'd be willing to train me. So she said, yeah. So I went to her office 2 days a week for a year while I was running my detail business, and just trained with her and learned the ropes. And then a year later, I sold my auto detail business and got into mortgages. And so honestly, I never ever wanted to own my own shop again. I didn't want employees ever again. But unfortunately, my experience was there was a lot of owners of companies that would promise things and wouldn't deliver. So that's when I just said, okay, I'm gonna go do my own thing, which is I had a franchise, if you will, of some other banks, and was able to operate um, on my own, if you will. And until I decided just to actually start my own company. So the licensing, you got to get licensed, and with every state that you want to do loans in, which we have a system that does that. You got to, obviously file all this stuff with the state and create, your corporation and corporation documents and so on and so forth. But we had the team already. I already had the people in place that we had been working together with for some time. So we kind of all, they say how to eat an elephant one bite at a time, right? So we all kind of divided and
Yeah.
conquered and got everything set up. And over the last 6 years, we've gone through several state audits, and every time we go through an audit, we learn a little bit more, we get a little bit better, and so yeah, now we've got a pretty well-oiled machine.
Yeah, so going through COVID and then now into the current market with interest rates
Oh,
hitting the floor, the bounce back, with the Fed raising rates, and now we're starting to see some light at the end of the tunnel as far as inflation coming down to a point to where now we're starting to think that, the first rate cut might be coming at some point later this year. Walk me through what the past few years have been for Advantage, for the industry as a whole. and kind of what to expect moving forward.
Yeah, 2020 and 2021 were, markets like no other. You know,
Hmm.
the Feds, buying all of our treasuries, which that's what was causing our low rates, because we had a buyer for our treasury bonds, and the Fed was buying all of our treasury bonds, which was artificially driving rates down, which was great. But man, it was like getting waterboarded with loans. It was great, but it was too much.
Hmm.
In my opinion, it wasn't good because now to the to the market that we have now, rates jumped 3% in like 60 days. And the
Hmm.
market, the consumer, nobody was ready for that. It was like there was no easy transition from the 2.75 to 5.75. I mean, it happened so fast that it literally shut everything down for a bit. Um, so we went from this machine that was just going so fast to a halt. And so unfortunately, that caught a lot of people that weren't financially ready, and that's why we've seen a lot of people get out of the business and companies go under because they couldn't slow. The caboose ran into the engine. The engine stopped, but the rest of the train just kept going. And so,
Hmm.
luckily, I've been through this a couple of times, so financially we were set. I knew at some point that those rates couldn't last, so I had put a bunch of money away knowing that we were going to come to this. But yeah, it caught us all off guard, and the consumer, got spoiled. And even today, people are still saying, "Well, I'm going to wait until rates hit 5%." When in reality, if you talk to any economist, a solid 6% mortgage interest rate is actually really good because it keeps treasuries at a point where people that have investments in bonds are actually making some money. And that was a big issue with some of people that were on fixed incomes that had, bonds in their portfolios. They weren't paying anything. So a 6% rate environment is actually pretty healthy. I mean, I remember writing loans as fast as I could when I got into the business at 8.5. I mean, as
Hmm.
fast as I could write them, but that was normal. Well, it wasn't normal. That was good because it came down from 10, in the 90s, and you go
Hmm.
into the 80s, and obviously it's getting worse. But so 22 and 23 was a realignment of expectations for consumers.
Hmm.
Everybody thought, oh, somebody's going to come to our rescue. The government's going to come to our rescue, and rates are going to come down. Well, never did, and there wasn't anything in sight to rescue the mortgage, real estate, home sales environment. Um, and so this last year, when everybody was like, okay, the Feds are going to lower rates, I was skeptical of that. I'm one of those that's like, okay, if it happens, great, but I'm not going to bank on it. And I'm sure glad I didn't because they didn't. You know, the economy, inflation is finally just ticked down a teeny bit, but it's
Right.
still not where they want to see it. And so, even if the Feds drop rates a quarter, it's not going to affect mortgage rates like dramatically. Um, Personally, my gut feeling is I think we got a solid 9 more months before we're going to see some change. Could it happen sooner? Absolutely. I mean, I've seen rates drop a point in a day, and I've seen them go up 3 points in a month. So anything can happen. But I just typically like to take the conservative route. Just I think maybe in 9 months we could see rates hit 6, maybe 5.5. I think if we can hit 5.5, I think we'll be, pig in mud, if for lack of a better word.
Yeah, and in general, I think some of the best advice is that, I mean, today in general is going to be the best time to buy. Yesterday is the second best time, because you never know what the market is going to do and what will happen. And as soon as interest rates do come down, that's just that many more people that are able to qualify for higher, loan amounts because of lower rates. They can afford more, and just basic math that, more demand, that means that prices are going to continue to go up. So even if you do have a lower interest rate, you very well might have a higher payment because you're paying more for that property. So just in general, it's good principle to get into something, start building equity, and if you can take advantage of lower rates down the road, then great. If not, then at least you're building equity and investing in property. The average consumer, when they hear that rates have dropped to 0.5%, when the Fed has dropped rates a 0.5%, it's not a direct correlation to mortgage interest rates. Can you talk about why that is and some of the background behind that?
Yeah, when the Fed drops the Fed rate, that's the rate that banks can borrow money at. And what that does is it can potentially stimulate the economy because businesses can borrow money cheaper. Um, Auto loans become cheaper, credit cards become cheaper, equity lines become cheaper. So then the consumer has more money to spend, which typically will help, you know, bring money back into the market. What affects mortgage rates are treasury bonds and what they're trading at. So, and that's all emotional. The just like the stock market. The stock market is emotional. And typically when the stock market's doing well, treasury bonds don't. So they kind of counterset when the stock market's not doing well, people jump into treasuries and that drives the yield up on treasuries, which drives rates down. So it's good. I mean, it's a good sign, and that's what makes everybody feel warm and fuzzy, which again makes the emotional piece better, which does help for treasury bonds. So yeah, a lot of times people think, oh, rates dropped a half a point. Well, then we got to just kind of wait and see. Typically, the mortgage industry or the stock market slash treasury bond market, they'll preemptively drop rates in our side a couple of weeks before trying to gas or time the market, if you will. So typically, before the Feds are going to announce that they're going to drop, is the better time because we're going to start to see rates go down before that. As far as mortgage rates, usually when the Fed does that, we're already saying, "Hey, rates are better. Rates are better." We're trying to tell our customers,
Right.
but sometimes they don't believe us, and that's the hardest thing. Um, but yeah, and one thing, if I can tangent a little bit, one thing that 2000, COVID in 2020 and 21 taught us is that there's a lot of demand out there, and there's two things. So one is they're not building enough homes. Home building is down like 10 million houses over the last 10 years. So there's a lot of demand because we're not building enough homes to suit the demand, which is why we're still seeing, 2 months of inventory on the market. And in order there to be a seller's market, it's got to be closer to three, to where it balances things out and prices will um, stabilize. So until the supply increases, the demand's still there. So in effect, when rates drop, let me back up. There was a study that Fannie Mae did, and they basically said there's people that are waiting for certain increment of rates. Like there's a certain sect of the market that's waiting for six, and they're going to jump in. And there's a certain sect that's waiting for 5.5, and that's when they're going to jump in. Like everybody's got their number, and it's pretty significant. So if rates drop and we don't have the supply, it's going to drive prices up. It's just going to. We're already seeing a little bit. There's definitely multi-offer situations on houses even right now. And if rates drop considerably, a lot of people are going to get in, which means that prices are going to be, yeah. So to your point, if I can buy a house at 400 today at a 6.25 rate versus 450 at a 5.5 rate, you just lost 50 grand of equity, right?
Right.
And your payment's basically going to be the same. So you just lost out on 50 grand. So that's where the power of buying now is in the equity when this thing all does turn around.
Yeah, that's just basic economics, supply and demand. And then, touching on your earlier point about rates, that's why if we assume that interest rates or that the Fed drops their initial rate, September 18th, then mortgage interest rates will typically trend downward leading up to that. And then, as you mentioned, once they actually make the cut, the mortgage industry has already seen that benefit. So
Mhm.
it's not like rates are going to drop an additional amount.
Mm-mm.
It's already happened. So, yeah, trusting your mortgage advisor, and we're watching this stuff all day, every day, trying to predict what's gonna happen and following what's going on. So,
Well, and the big thing is, okay, you buy the house now. Let's say your rate is 6.25 on an FHA is what I just locked one the other day, and rates do go down, then you can benefit from refinancing. But at least you've already bought the house. You've already got it. You're not in this competing market where you've got to offer 20, 30 grand over the asking price and figure out how to pay for that. Because a lot of first time home buyers, they just have, enough money for their down payment, not excessively over that to be able to pay for more. And then you have to worry about appraisals coming into value. So yeah, there's a lot of moving pieces to it, right?
yeah, and then also another part of the current market is that in certain spots, you might be able to even get some of your closing costs paid for by the seller, whereas when you do get into those high competitive, um,
Oh yeah.
properties, you're gonna be having an offer over, you're gonna have to waive appraisals potentially, or at least that's what was happening back
Oh my
during
gosh.
COVID, some crazy stuff. You have much more leverage right now as a buyer than you did in the past, and then you will in the future as well.
Yeah. Yeah. I mean, again, you never know. You never know what's going to happen. I mean, in order for prices to drop, it's going to be some catastrophe, massive catastrophe financially. I mean, could it happen? Maybe, but yeah. Other than the mortgage industry is not going to cause another crisis. So I know a lot of people think, well, I'm just going to wait for the housing crash. There isn't anything on the horizon that shows that, unless somehow our economy just goes completely, you know what, and that means everybody's going to have a problem. But there isn't anything on the radar that's going to make houses go down, prices anyway.
Yeah. Well, yeah, I really appreciate it. Any closing thoughts or words of advice to someone that's out there that's either a consumer, potentially a lender out there, a real estate agent about this market, about heading into the future?
Just be prepared. For a consumer, I'd say get ready. Get pre-approved. Make sure that you've got your loan dialed. Get all the income documentation, because what we see is people start looking online. They see this house and they want to go look at it. Or maybe they don't have a reality of what that payment's going to look like, because it's
Mhm,
going to be dramatically different than it was 3 years ago. So just knowing what your budget looks like, because oftentimes we can approve people for much higher of a payment than they feel comfortable. So having that conversation with your loan officer, looking at the different loan types, because there are reasons why to do conventional versus FHA versus USDA, so on and so forth. So just having that all dialed in, so that when you find the house, you're ready, and then you can just you know jump on it. It really does help, especially if you get as much documentation done. You may be able to do a 15-day close because you're set, you're dialed, and you can
mhm.
offer that as an incentive to close fast. As for everybody else, just yeah, stick to it, be vigilant, and doing the things that you need to do if you're an agent to stay in front of your customers and be a valuable resource, trusted advisor, if you will. It's a big part of it.
Yeah, and as with anything, yeah, the people that are providing the most value are gonna be the ones that will have the best businesses long term, will have returning customers and really thrive, especially in the future market when things do get better. So, really appreciate you coming on, Derek, and sharing your story and some about Advantage, and we'll have to get you on some time in the future.
Yeah, absolutely. We'd love to.